Perfect. Well, good evening, everybody, and welcome to the podcast this evening. Thank you for coming. Thank you for tuning in. We've got quite a few people on the line, and I just wanted to say thank you for taking the time. The topic today is investment opportunity to invest in our a hedge fund, alternative asset fund, called the BT Global Growth Fund. And delighted to present it to you. I hope I can keep this a little presentation somewhat entertaining and enlightening. I hope you learned something from it. Certainly at the end, we'll give you a whole bunch of investment ideas that we're in right now. So I'm just I'm gonna run you through it. And again, thank you for being here. The fund's called the BT Global Growth Fund. Long short equity. Okay, so we do short stocks for a living. We try to hedge it out. We're value investors. Capital preservation is a big part of our strategy, and hard assets. We're going to talk quite a bit about owning hard assets, and this fund will do that for you. A little disclaimer: we are not giving investment advice here. And please check from our website, and you can read the disclaimer in details. So who are we? Well, we're based in Montreal. Our head office is here. We've been in business since 2006. My partner, Jacques Lacroix, and I founded the firm. So what's that, 19 years? We've been compounding at 7.65% as of this month per year, net of all fees and expenses for 19 years, which is pretty good. We are Jacques and I, by the way, have been working together an extra 10 years. That's 20 years of running the fund together, and we worked together at a previous company for another 10 years. So management team that's been together 30 years. I don't think you're going to find too many partnerships in the investment world like that. We're value oriented. As we said, we do not buy expensive stocks. We do not make investments in companies that are ridiculously overvalued. We do quite the opposite. We like to buy companies. It's all based on cash flow, right? So we're looking for companies that trade at multiples of cash flow in the single digit. Ideally, 2 or 3 times. You buy a company at 2 or 3 times cash flow that's public, you're going to do well over time. And you short companies that trade at 150 times revenue, and with lots of debt, and in competitive industries, that's going to work out over time as well. We are looking for outsized returns. That's what we spend 80% of our day doing, looking for opportunities. And we fundamentally believe that the Canadian stock market is not efficient, and frankly is getting less efficient as the years go by. So we're a firm believer in that, and so we like to exploit the opportunities on the upside, find undervalued stocks, and we like to short stocks that can go to zero. What's our advantage? What makes us different? Well, the teams, worked together for 30 years. We think we have a fairly intelligent way of investing. So just to be clear, all our money is in one fund. So we're all in this together. And Jacques and I have the vast majority of our net worth in the fund. So we're in it with you, side by side. And we're looking to do lower risk but higher return over time. And so what does that mean? How do you do that? Well, unlike many hedge funds, you don't know how much leverage they would use. Many hedge funds in the US, for example, could be levered up 5 or 7 or 10 times. We don't use leverage. Okay, it's minimal. We could lever the fund 30%. And we have gone to that level, but that's the max we could do, and it's in our documentation, and we can't do more. So minimal leverage, so makes it, I think, a whole lot less risky. We're value focused. I think that takes a lot of the risk out. We're pretty good at stock picking. We can talk about that later. Um, we're not going to be a big fund. The whole idea of managing billions of dollars and looking for outsized returns to us is frankly, it's just not credible. It's not even doable. It's certainly not in Canada. And so we're going to keep the fund small. We've always been relatively small, and we'll never get the fund above, say, 250 million would be the max. The other thing is communication. We're very open about what we're up to, what we're doing. We communicate with our investors all the time, and we run it like an open book. Really, we have no secrets. We share our information with other smart people in the business and like-minded folks that like to make good returns. And we have a number of firms and brokers and clients, frankly, that we work with across the country, and we openly communicate with them, share our ideas, and I think it makes for a smart way to outperform. Now, why do you want to be in hedge funds? I mean, we shouldn't even call it a hedge fund. We should call it an alternative asset fund. Alternative, well, long short. I mean, you cannot be in these volatile markets and not be shorting stocks. Long only just will not and cannot outperform long short funds in our opinion anyway. So we're very active on the short side, and what can I tell you? We spend most of our time looking for good short ideas to offset the risk of having equity exposure. Our goal is to outperform the markets. Okay, most people will, professionals will tell you it's a waste of time. You can't do it. We think you can, and we've been doing it for years, and we plan to continue. So we think it's a smarter way to invest, right? So minimal leverage and long short. Well, we're diversified, right? This fund is not, we will invest over 30 funds, 20 to 30 companies on the long side, 10 to 15 on the short side. So you've got lots of diversification. We can only have a maximum of 20% in any given industry. So we are going to be diversified, maybe not diversified across, every industry or 10 industries or whatever, but certainly 6 or 7 different industries where we'd have significant weightings. We look for opportunities that where there's inefficiency. So we are not big fans of playing in the large cap Canadian stocks or indices. So we don't play the banks. We know all of you on this call are, I'm sure, owners of Canadian bank stocks. So we're not going to invest in Canadian bank stocks. We will invest in GoEasy, a company that trades at lower multiples in Canada than all the bank stocks, has a higher ROE, has less debt, and is very well managed and has a better track record, frankly, than many of our banks will do that for you. So we look for alternative opportunities within certain sectors. We're not going to play the utilities. We're not going to play the telecos. In fact, we don't play really Canadian-focused companies. What we're going to do is we're going to get you invested in exciting companies, international companies, companies focused outside of Canada, but are listed here in Canada. Why? Because that's where the maximum inefficiency is. There's not a lot of inefficiency between Bank of Montreal and Bank of Nova Scotia stock. People arb these opportunities out all day long. But, do they play GoEasy? Probably not. It's a $4 billion company, and that's under the radar of the largest pension funds in Canada that won't touch them, and the banks won't touch them. So, we look for opportunities in the smaller cap, but maybe not minuscule cap, just smaller than the biggest of the big. I've got some examples here. In Canada, there's Nortel, if you can remember that far back. Nortel went to zero, right? It was Canada's largest company, and 3 years later, it was at zero. So don't tell us that there's no volatility in the Canadian stock market. Pharma stocks, remember Valiant went from $30 to $300, and then was back to $25 in 5 years later. How about Concordia Healthcare? That was one of our favorites. We invested around $6-7 a share. It went to 100. We sold everything at 60. The stock went to 120. and we started shorting then because the valuation was ridiculous. We went on BNN, talked about how we thought the stock was destined to hit $1 by our forecast, and sure enough, 8 months later, the stock hit $1. So when you go from $120 to $1, there's opportunity to make money on the short side. Now these things are kind of rare, but they do happen in Canada, and we seem to attract these kind of companies, and there's momentum on the upside to take them to healthy valuations, and then sometimes they just get ridiculously overvalued, and there's opportunity to play it on the downside. We can talk a little bit about the fund. We by the way, we have all this on the website. Just go to btglobal.ca and you can read all about our fund and the objectives. This is the only thing we do, right? The team runs this fund, and so we're very much focused on it. We have a trust. We have the fund, which is not RRSP eligible, or unfortunately. It's a limited partnership, so it cannot be. And then we built a trust that is RRSP eligible, and the trust, the only thing it does is invest in the fund. So you can invest from your TFSA and whatnot, but you'd have to do that through the trust. We talked about our investment style. We've got this track record coming up on 20 years. We go into detail about our strategies, and I'm going to outline some of our strategies today, but we describe it all in quite a bit of detail. And we charge fees. Everybody asks about the fees. We charge 2 and 20. So we have to make you pay 2% per year, which is quite a bit. Some would argue that that's too much, but the reality is in Canada, you don't pay 2%. You're all high net worth individuals. It's all tax deductible. You only pay 1%, right? The government pays the other, and you don't pay a 20% carry. You pay basically half that. That's all tax deductible as well. In fact, all our expenses, we do all the tax work. We provide all that for you, and you get the annual deduction. But we do charge 2 and 20. So we have to make you back your 2%, and then we have to make you 5%. So once we've made 7% in the year, then we split the profits thereafter, 20% for the management and 80% for the investors. The team, Jacques and I can tell you, Jacques one of the most impressive finance minds in the country. We've been working together for many years. Graduated top in his class. What else can I tell you? We're both educated in finance. We've been in business. I'm coming up on my 40 years of being in the investment business and in finance. You can read our CVs when you're terribly bored one day. We do have a expanded team. We've got Evan Weiser's joined us. He's a tech expert, investment expert. He's got his own fund, works out of our offices. Very talented investor, money manager. Jim Shannon runs our exempt market dealer business, and David Creighton, our chairman. Incidentally, you can listen to David and myself. We do a monthly podcast, which is all on our website as well, and we give you some ideas on what we're up to and what our thoughts are, and very brief podcast, 15-20 minutes, just to give some insight into what's happening in these volatile markets. So how do we find these opportunities? This is first of all, I'll tell you, if you want to be in this investment business and you want to outperform the indices, it's a full-time job, 80 hours a week minimum, looking for the opportunities, because it never ends, right? You need to follow. We follow over 200 companies for sure, on a daily basis, and just try to stay on top of whatever news is coming out in their industry and in these companies. Of course, we narrow that down dramatically to the investments of, as I said, 20 to 30%, 30 long positions. But we're still we're still following hundreds of companies, really. We have the unique advantage in being in Montreal. When companies come through town to go see investors, there's not 100 folks to go see. And we have the pleasure of hosting hundreds of companies in our offices here in downtown Montreal. The brokers bring them in. We sit, with CEOs. On average, 3 or 4 companies per day come through, and it's a great thing to do. It's a great opportunity for us. I don't think you can really do that in any other city, maybe in North America, but certainly it's an advantage for us money managers here in Montreal. So um, uh, we get very deep in, meet the management. The best investments we've ever made. We were very close with management, got to know them, got very comfortable with them. Frankly, after all these years in finance, I think the number one issue is whether or not management is capable and first rate. And you can make 10 times your money with excellent management team, and you can lose all your money with mediocre management teams. So it's all about management. We like to meet management. We do a lot of financial analysis. We like to invest in, take large positions in companies that have extraordinarily low cash flow multiples. And we've done it many times. I've got a couple of stories for you. We're investing in a couple of companies right now today that trade at 1 times cash flow, if you can imagine. 1 times EBITDA. It's hard to imagine. We've got a couple that are trading at 2. We've got a whole slew trading at 3 times EBITDA right now as we speak. You don't find companies like that in the U.S., but in Canada we seem to be able to do that. We have a few preferred industries that we're excited about. So pick your industries, pick the best companies in those industries, follow 200 companies, and invest in 20. That's the philosophy. We're quite active in new issues. One of the most the exciting returns we've had in the past is companies come public in Canada. They're maybe bought deals happen or block trades and whatnot, and the brokerage community gives us the opportunity to get into or get involved in some of these opportunities. We're very active in new issues, and in bull markets in particular. You can do very well, getting good fills from our favorite brokers. And a lot of work goes into this. We don't play in all of them. We don't get invited into all of them, frankly, but occasionally, I'd say, once per month, we'd get an opportunity that we really like. You get the chance to buy into new stories, and that's one of the best reasons, frankly, to invest in a fund like ours is we do get to see deals that frankly retail folks just don't have the time or opportunities, right? So and we get to meet management. Most of the new issues that we invest in, we already know or are meeting and management teams. Connected, we're fairly well connected here in Canada. We spend most of our time with, frankly, the independent brokerage houses. We're CIBC is very involved. All our funds are with CIBC, right? All your money, we never touch your money, right? You invest in our fund. The fund is all registered. All the securities, cash, whatnot is registered at CIBC. And they're basically the one bank that large bank that we deal with. Then we spend most of our time with the independent brokerage houses. So Canaccord, Ventum, Raymond James, Cormark, Stifel, Research Capital, Beacon Securities. All of these folks are a little more entrepreneurial, I would say. They're all very active. And so they've got research teams, corporate finance teams, trading teams, sales folks that contact us on a daily basis. And that's where we feel most comfortable. We work with a few other money managers across the country that we're close to. McNichol Asset Management, we've been with since the beginning. They helped us get started years ago. We've got terrific accountants at PSP Wajali, do a terrific job for us. What else can I tell you? Anyway, I guess the concept is we spend most of our time with the independent side of the brokerage community. Performance. It's all about performance. As I mentioned, we've been compounding for 19 years at 7.5%. 7.65 net. Your money's tripled over that period of time. Now is a good time. We think we'll get into it in a bit. In the last, 9 months, we're up, I don't know, 13.5%. Year to date, we're up just under 4.9% in 25. We think timing's pretty good, which to look at our fund now. We can talk about that in a second. There's this concept that in this graph, I think it explains it fairly well. When the U.S. versus Canada, and of course, it's all been about America in the last 10 years, but I don't think too many people realize that, in fact, the U.S. outperformed Canada back in the late 80s, all the way through to the late 90s. You wanted to be invested in the U.S. But then there was a period of time, 10 years, where Canada dramatically outperformed the U.S. And we launched the fund at sort of 6 years into that process in 2006. In fact, Canada outperformed so dramatically that it was kind of embarrassing to put up the U.S. Comps compared to what was going on north of the border. But for the last 10 years, it's been or 12 years now. So it's exactly as before. In the 80s, it was a 12-year span of U.S. outperformance, and we've just gone through a 12-year span of U.S. outperformance. But what's the next move? Canada, in fact, is outperforming over the last few months, and the valuation of Canadian listed stocks is so dramatically more reasonable or cheaper or better value than what's going on in the U.S. So it makes sense to us anyway that the turn is coming. We'll see. We think it's happening as we speak, but our thesis is that for many of the sectors that are much larger weightings are here in Canada. So it makes a lot of sense. If you even go down to the smaller cap space, it's very much happening. The TSX V or the venture, the smaller cap stocks have all broken out. Or I mean, not all broken out, but the group as measured by the TSX V composite, venture composite, has broken out. It's quite dramatic, and it was confirmed that technical folks are advising us that it's 650. That was the breakout point, which was done now. Now we're up to what's that, 792. It's pretty clear how far up could the venture composite go. Well, it's hard to tell, but it's had a very tough last decade. More than that, probably 11 years now, and it's been out of favor. Small cap's been out of favor, but there's all sorts of value everywhere. It is breaking out. How high can it go? Much, much higher. So we do spend quite a bit of time focused on these stocks. So I think that, as I said, timing is good. I think we think it's happening. We talked about it happening. We've been talking about it for a year now, but it is in fact occurring as we speak. On the investment side, like volatile markets, there's lots going on, lots of noise, and what do we know for sure as investors? What can we say at the end of May in 2025 that we know absolutely for sure? Well, there's one thing that and we put this in a slide just to discuss it, and it's not going to change, we don't think, for years. Donald Trump's coming back into power. All that discussion about Doge and reining in the waste and the excessive spending on the U.S. government, finding $1 trillion of cuts. It's all doable. That was the talk before his election. He made it happen, and Doge has been doing its thing. But what has become very clear in the last few weeks even is that the Trump administration is not going to balance their books. They are not going to be able to. They may cut $1 trillion out of their budget, but they're going to add $2 trillion. They're going to increase spending in all sorts of areas. particularly the military, right? That was the recent announcements. It is clear they're already running, 5-6% deficits. They're going to be higher than that. In his first term, he ran deficits. It looks like it's going to continue. So Canada's no better, really. We'll run lower deficits on a ratio basis, but we've been running huge deficits for a long time. It's not going to stop. The new Liberal Party under Mark Carney is not going to balance the budget. That's not happening. Germany just announced a few months ago that they're embarking on a whole stimulation program. They're going to boost military spending and everything else, and they forecasted out 7 years of larger deficits, dramatically larger. And of course, Japan is just going to continue on its way. It's already has an enormous debt level, and really, it's not clear how they're going to correct that. Therefore, fiat currencies, all of them, are going to be in a continuous cycle of debasement. Of everybody wants their currency lower. Who's got the best of the worst? I'm not sure, but they're all going down. This is irresponsible of all of our governments. I don't think any of these are great policies. Could be good for the stock market, could be good for real estate and certain assets, but it's going to be very good for any real or hard assets. And you better have large chunks of your net worth invested in hard assets. And we believe this. We believed it for years, but with the Trump administration, there was a hope of some sanity south of the border, maybe on some kind of fiscal, I don't know, appropriateness, but it's not happening. And so all these governments are misbehaving. It's going to go until a crisis. One thing's for sure: hard assets are going to continue to rise, and of course, there's inflation, right? And the best protection is to own hard assets. And what are hard assets? We'll go through a few, but I mean everything you can think of. Real estate, gold, silver, platinum, palladium, uranium, all of this kind of stuff, and then of course the equities around it. So let's talk about it. Silver. We've been on the show. The Mike Campbell's generously invited us out to the World Outlook Conference. Each year we talk about this ad nauseum. Of course, gold is a favorite subject on MoneyTalks, and I'm not going to go into gold too much today, but we are big believers. Where's gold going? It's going higher. Is there any price that you can put on it? People would think if you talked about $5,000 gold, you were crazy. And certainly back in the 80s, some people were talking that it would get there. Well, now at $3,300, is gold going to get to 5,000? It's not so crazy. In fact, it's highly likely. We're convinced it's going to four in the next, I don't know, year to 18 months. I mean, the trend is there, and we don't see any way it's going to stop. Can it go higher than that? Of course it can. And I don't think anybody really knows. So, but we do find it quite fascinating. Its little brother, silver. I think silver is way underperformed gold, and it doesn't really make a lot of sense because, in fact, silver demand, 3,000 different applications for industrial applications for silver. Silver is consumed. There are not big vaults of silver around the world stockpiled. Silver is more volatile. Silver will have its day. It does every 20 years or 25 years. Remember back in 79, 80, I remember very well with the Hunt brothers and running the price of silver up manyfold. 2010, 2011, we played that. Silver went up fourfold in a year and a half. And we participated in all that in the fund. The fund did very well. And we learned that in the end, you could own all the best silver companies in the world, and you could study them, get to know management, understand the type of mines they had and the grades they had, and blah blah blah. In the end, silver itself outperformed all silver equities. And we kind of think that'll happen again. Why? Because we've met with all the silver companies. There aren't that many. There's probably 10 producers that are public. There's many more exploration companies, but you add them all together, you're probably at 30, 35. That's it. It's a tiny industry, and frankly, it's not easy to find a great silver company. I mean, exploration opportunities, sure, there's lots, but producers that are at reasonable valuations and have great growth opportunities, it's not so easy. So what we've decided to do is buy silver itself and get leverage on it, because you can buy 3-year, 2 and 3 year calls on the SLV, and the volatility is only about 25, right? And the volatility on most stocks, most equities are in the 30s, low 30s, and if you want to buy volatility on Nvidia, for instance, it's going to be 50. But silver, which we could put together a very bullish case that silver prices could spike, and you could see 60, 70, $80 silver in the next year. It's possible, and you can buy these calls with a low vol, and you can get 2 years and even 2.5 years, 3 years of time in your favor. So we're buying at the money, just out of the money calls. The key price to us is $33. The breakout price is $33, $34. Guess where silver's trading right now? $33.50. It's right there. So if it goes to 40, it's going to 50, and in a hurry. And you've seen it over time as these spikes happen. So why wouldn't it happen again this time? So we recommend that as an investment opportunity. We have it in the fund, and as it starts to move, we'll be adding to those positions. Gold, we've talked about. Well, what gold stocks do you want to buy? There's been a lot of activity, and some stocks have done very, very well. The biggest guys, Barrick and Newmont, the two largest players, stocks have done very poorly. They're not very well managed companies. They have not done well over the last 10, 15 years. They're too big is the problem. They need to buy companies to grow, right? So forget that. So you have to go down a level into sort of the mid-tier gold plays, and there's much more opportunity. They've done well, but they haven't. Gold's far outperformed at $3,300 gold. All these producers are printing cash, and so you've got to have a bunch of gold stocks. We're maxed out on our gold positions. It's like 20% of the fund, has been for a long time, and we keep it there. It's probably our preferred, favorite sector. We can't go above 20%, but we would if we could, right? So here we go. Aris Mining. I mean, I recommended this stock back in February. I think it's up like 65% since February 1st. Why? And do we like it? We like it more than we did 60% ago. We've learned a little bit more. They've made a few more announcements. It's clear that some of their growth plans are working well. So if you can believe it, the stock's broken out to new highs. It still trades at 2.7 times next year's EBITDA. Okay, this stock trades on the New York Stock Exchange as well. There is not another company, I don't think, on the New York Stock Exchange that trades at under 3 times EBITDA. I think the earnings ratio, the PE ratio, is something like 6. Trades at 6 times earnings, next year's earnings. This company is going to enhance their mine in the month of June, right? Their main mine. They're basically increasing it, 50% or more this year, this summer, next month. They've got another mine that they're dramatically increasing the size of. It's operating now, but a big expansion plan for next year. They've got another mine that they're going to bring into production the year after, and they've got another mine that will come on in 28. So this is a growth company trading at a ridiculously low multiple. They've got a fairly strong balance sheet, actually. The one problem they did have was they had a lot of debt a few years ago. So maybe you can understand the low multiple. Today the balance sheet's actually quite strong. They're printing cash. They can fund all of these projects on their own, and no one of the stock's breaking out. We think the stock just continues. So you invest in a fund like ours because we find these things, we follow them, we stay on top of them, and as management performs, and as the business opportunity plays out, in fact, you don't sell, you might actually add. And as the fund gets larger, we'll add to the stocks like this. And so this is where's the stock going to be in 3 years? I mean, look, one of the analysts told us the other day that he said, well, the stock's going to $15 this year. That's for sure. That's just his words. And then this is just last week. He told me this at a conference I ran into him. He goes, well, it's going to 15. That much we know. And my NAV is $36 a share. Okay. So stock's at $8.90. Anyway, not a small company either. So there's one for you. And by the way, we'll probably come back to the World Outlook Conference in February and talk about this one again. Another top pick, another company we got to know, and as I told you, management comes to our offices. So here's the management team of Kit's Eyewear shows up in our offices 2 years ago, and they come in, they tell us their story. It's about being one of the only places where they manufacture eyewear glasses. Here's a set right here, Kit's prescription glasses, and then they'll you do it all online, and they'll ship you the glasses within a day, maybe 2 days. And they do all the work. They source the frames, and then they make the lenses for you in their factory, and they do it very cheaply. The margins in this business are insane, right? When you go and buy in some retail store, you pay $500 for your pair of glasses. The frames may cost $10, and that shop, by the way, calls a factory to make the prescription lenses, and and then they're shipped to that shop the next day. So we're just doing the same thing, except we're eliminating the retail store. And the margin, on those $500 glasses, you'd be just shocked at just how much money they it actually costs to make them. It's probably $40-$50 to make those glasses. So these guys are going to do it all online. They're going to run a low cost operation and try to build a good sized business. So he's in Montreal. They're doing the presentation. They went around, saw a bunch of other investors, and the stock was unbelievably cheap. It had a tough time coming out. It'd been public for a while. Had a tough time. People weren't enthralled with this new development. It's a unique company, an orphan stock, if you will, and that was the bottom for the stock that day in Montreal, because a bunch of investors just said, institutional investors just said, this opportunity is too good to pass up, and lots of buying, all the selling's done, and that was the bottom. And so where's it going from here? Well, I think it's up. I recommended it at the Outlook conference in February. I think we're up like 45% from there. Our firm has a $20 target on it. I think the street thinks $20 is quite reasonable, and they are actually accelerating their growth. They came out last week, I think it was. They said we plan to have 125,000 new customers in the next quarter, Q2 of this year. So this is a hyper growth story. And how many Canadians need glasses? I mean, my goodness, it's a huge market. So big opportunity there. Again, just an example of buying value, seeing an opportunity, getting to know management, getting a toehold in the stock, and as the company does well, you buy more. And we're more bullish on this stock now than we were when we first met them. What else? What other kinds of things do we do? Well, here's one for you. The space world. We met one particular research analyst who said the most fascinating area for him is space, and we know nothing about space. But by the time an hour went by, we're like, wow, this is opportunities that are, growth industry for years out into the future. Of course, governments are heavily involved. Military is heavily involved. Lots of news on space. Well, guess what? Canada's got two fabulous companies directly tied into this industry. MDA Space. We met management. I couldn't believe it. This just a year and a half ago, I guess management came into Montreal, sat down with 20 institutions, and said, "Well, our company is going to grow. It's going to grow 35% this year or more. We're going to grow 35% next year. In fact, we're going to grow 25 to 35% per year for the next 5 years." And we have that kind of visibility. And I'm scrambling to figure out what is the multiple of this thing. And it's a billion dollar company back then, and the growth is unbelievable. And then the multiple was like 7 times EBITDA, 6 times EBITDA, with a strong balance sheet. So we bought, and it became our largest position. The stock went up every day. There's this run you can see from July to December last year. The stock went up every day. So the world wakes up and realizes that this thing is just too cheap. So these guys make the satellites, and you saw what Elon Musk did with Starlink, and some people are thinking Starlink's worth as much as $200 billion, right? It's buried within SpaceX, but it's a big part of SpaceX's valuation. And $200 billion. Well, these guys make satellites to compete with Starlink. And Apple became one of their clients. So that got the street excited. Apple put in an order for, I think it's like 60 or 70 satellites, and these guys have the capacity. They're the only people in the world, actually, only company in the world that has the capacity to build thousands of satellites. They want to build 2 per day is their the capacity for the company, and the CEO mentioned that he thinks Apple may move their order from 60 to 300. And then when somebody asked him, well, could it be bigger than that? He goes, oh yeah, it could be 3,000. So when you've got Apple as a client, and they're going to compete against Starlink for sure, and Starlink's got thousands of satellites running around the Earth right now. MDA space is really the go-to name for constructing these satellites in volume and scale, and being able to deliver. This company's been around 60 years. They know exactly what they're doing, and the stock is cheap. It trades at 9 times EBITDA, I think, something like that, which they have a $5 billion backlog. It's too cheap. Now you see the stock got hit in the recent turmoil in the markets. It's now rebounded right back to where it was. It's almost at its all-time highs. So I think we're back on track. With new contracts, then the stock goes higher. Simple as that. Very exciting. And so, by the way, that's our largest position now, MDA space, and we're not selling shares really. We like it. How about this? Telesat, same analyst, David McFadgen over at CoreMark, said, well, if you like MDA and you like that story, you should really take a look at Telesat. So these guys operate the satellite network, so the low Earth orbit satellite network, and so they're going to compete directly with Starlink. They're scheduled to be in business in 2027, so still 2 years out, but they're going to launch these satellites in 26, and they're signing up customers now. By the way, 27 in the satellite world or in the space world is like tomorrow. Public company, been public for a long time. The stock's done fairly well. It's fallen back, retrenched in this latest little setback from Trump's inauguration, I guess. But the news is good. The news keeps coming in. They keep signing new deals. They've got a backlog for this. They're calling it Lightspeed, their satellite network. They've already sold like $1.1 billion of revenue when this is up and running. It's a very profitable business. And we think they're going to just keep signing contracts and announcing them, on a monthly basis for the next couple of years. So you can buy, you might get a chance one day to buy into Starlink at the $200 billion valuation or something around that. But you could buy this company at an enterprise value of 5 billion Canadian. So let's call it 4 billion US. And by the way, their network technologically is superior to Starlink's in many ways. So just last week, rumors are flying around. I'm not sure just how true this is, but they're saying that that Trump's the globe, this defense sphere he's going to put up over the U.S. and Canada, hopefully Canada. He's his Golden Dome, whatever. They want Telesat's technology to help them manage the that defense initiative. So what's that worth? I mean, anyway, these guys are in the right business at the right time. There are not very many players, and the stock is ridiculously inexpensive. And I think this would you've got to be very, very patient, which we will be. We own it now. We'll add to it as things develop, and we'll likely own this thing 3, 4, 5 years from now. So I think that gives you a little idea of the kinds of things we do. Hope this has been informative, a little bit useful for you. We would very much love to have you consider our fund as a place to put some of your investment capital. I'll leave the contact information out here for you. As I said, we run the fund like an open book. We tell if you call us, and we'd love to hear from our investors. We speak to our investors all the time. We communicate on a monthly basis. We send out like a monthly report. You get a statement every month on your account. The number of units you own, what's the value per unit, what's the total value, and then we send you a monthly report telling you what we're up to, what our thoughts are, and but then we put our cell phone numbers on our distribution, our marketing documents. And here are, I'm not sure we have our cell numbers here. We have the office numbers. We have our emails. No, there's Jacques and my mobile numbers are there. So you can reach out and we'll tell you what we're doing as we're doing it. We'll tell you what we're excited about, how we see the markets. And frankly, there just are not many people in the investment world running hedge funds that will do that for you. And people are shy to reach out, perhaps, but they should. And listen, we've been doing it for 19 years. We're not going to stop. We love to hear from you. We'll tell you what we're doing. And of course, you can call and complain that the fund's down 10%. Well, you can do that, but we own a big chunk of the fund ourselves. We'll be very much aware of how the fund is doing. What we'd rather talk about is what we're going to do next. Looking back is one thing, but we spend all our time looking forward. And so we view it as kind of a partnership endeavor. We have a lot of very intelligent, capable investors, hundreds of people that have their own businesses, are executives, senior executives in public and private companies across this country. It's all for Canadian investors only. At this point, we are planning on launching an international fund to do exactly what we're doing, but do it for international investors. We're planning on launching that over the summer, but basically all Canadian investors, and a lot of them running excellent businesses. We reach out to them to assist us in our due diligence and investment thoughts. So I think with all of that, I'm going to leave it there. I hope this has been useful. I want to thank you for taking the time. I'd encourage you to reach out to us, and we can send you documentation. I think now is a good time. Really do believe this hard asset theme is going to play out, and we're very much, I'd say half the fund is invested in things like we've been discussing, and hard assets is the way to go. I think we're going to do well. We could talk about Bitcoin. We've been convinced. I told Michael the other day, we've been following crypto for a bunch of years and not doing anything about it. We're now convinced because of the government's behavior that Bitcoin's going to do very well. It'll be considered another store of value, superior to buying government bonds that'll pay you 3 or 4% and then tax you and take half the money back. They won't keep up with inflation, whereas yes, Bitcoin will. Gold will. And anyway, I'll leave you with that. Thank you for joining, and Have a good evening.